Okay, so now we're going to start level 2 time frame analysis, round trips, and market stability. So this is interesting. This lesson is really all about why market turns happen. And to me, when I learned this and put this together, it was a big game changer for me to understand the mechanics of this. And so I want to endeavor to pass that on to you guys, because why is this a big deal? We are all terrified. We all love trading the pullbacks in general. But every time you trade, everyone has the same thought. I wonder if this is the turn. We all struggle with it. We are all wondering. It is universal. Okay. So what this lesson is all about is what really causes the turn. We are still going to continue to get caught in turns. So this is not a fix-all for getting caught in market reversals. So you got to have a contingency plan to navigate those. And there's a lot of things to do that. But what we're going to talk about is the mechanics of the turn. How is this actually happening? So let's get into it. The round trip and speed of money flow. A round trip trade is a complete trade idea execution from opening to closing. So that's a round trip. I have the idea, whatever it is, chart pattern, someone gave me a stock tip, doesn't really matter. I have an idea to make money in the market. I am in. That's the beginning of the round trip. The end of the round trip is closing that trade. Complete circle, beginning to end. So the round trip happens on different time frames, okay? From the tick up to the monthly in this example, sometimes higher. We got yearly traders that trade. They're in stuff for 5, 10, 20 years. Look at Berkshire Hathaway, okay? Those traders are operating on a time chart that none of us even look at, right? A monthly is fast for them. So this round trip speed, what we need to know about it is it is relative to the time frame being viewed, because most active traders are looking at some level of charts showing time mapping. And that's typically in the form of a bar candle chart, right? So on this example right here, we see on the left side we have trend stability, and then on the bottom we have round trip speed. So let's walk through the example here. We start with the tick chart, 5-minute, 15-minute, 30-minute. You see the center of this is getting bigger and bigger, and that's showing it's kind of a circle that's unfolding there. So on the bottom, we have where you're buying. We're talking about just general buying and selling. Buying to open a position, and then at the top, selling. As you can see, as we go up the time frames, the round trip speed increases. That is the speed of when someone is getting in and then how long it takes them to get out. Okay, why this is relevant is because the speed at which this round trip happens affects market fluctuations and available liquidity in the market. If somebody is in a trade on the 5-minute chart, I'm not even going to talk about the tick chart, we'll talk about the 5-minute. That person is looking at a 5-minute chart. That means that they are, if they're actively trading, they're going to be looking to make decisions to get in and get out 5 minutes at a time. So it doesn't mean it has to always be in and out on 5 minutes, but what we're talking about is relative chart pattern for someone looking at a 5-minute chart. Their round trip speeds are all going to be condensed around the patterns and the beliefs that time frame creates in general. Okay? That will affect their round trip speed. So someone trading a weekly or a monthly chart is going to be the extreme opposite of that. They're going to be looking at, hey, the weekly chart is maybe bouncing from this support level, or it's hitting a ceiling at resistance. I think I'm going to sell. That person will probably be in that trade for 2 or 3 weeks, just seeing if that initial thought was correct, that initial analysis. And then if they're in the money, they could be in the trade for another 3, 4, 5, 6 weeks. So the point is, we're not talking about necessarily the individual bar time frame, but we're talking about the chart in general here for round trip speed on these time frames. It's going to be influenced by the patterns that are created and the beliefs associated with those patterns that are born into the market. That's going to control the speed of transaction. So in our example here, daily traders see the breakout is heading, see that the breakout is heading up long. Their round trip will take at least a day to complete on the low end. So people, if they see that it's breaking out through a upper resistance area and they're saying, I want to buy with that breakout, and they're looking at a daily chart for all of their analysis, they're not going to know that they were wrong for at least a day. And if they're right, they're going to be in that trade for multiple days. So this is just a general basic example of how that's affected. Now, these beliefs are completely disconnected from the person that's trading a 1-minute chart. Smart 1-minute traders might take a glance at the daily, but that is irrelevant to them taking their, 5 pip trades, right? They're on a whole different time frame. So their speed of round trip, in, out, in, out, in, out, they'll do several trades, tons of trades before the daily trader will execute their round trip. So that's what we need to get to understand here in this first part. Okay. So what causes bull rallies to fail? Another example to get your mind in the right spot on this. So as we see right here, we're looking at a 4-hour bar chart headed down. You see these little green arrows that are at the peaks, which look like potential rallies, especially in the moment, right? If you're in the moment and you see these turns happen, you think, okay, is this the end of the bear market, right? What causes these to fail is the higher time frame round trip cycle. We call it the higher time frame flow of money. And why is that? Why this is because if the higher time frames have not bought in this case, because if they're shorting, that stable flow of money is holding this trend intact. If they have not bought, then the market can only go so high before it falls back in trend. Why is this? What we can see right here is that up to about the 4-hour and maybe daily level, that's the only traders that are getting influenced by these particular chart patterns at this point. So they may buy, but the only way a move is sustained, if you could think about this, and I don't have an illustration for this, but I'm just going to try to paint a word picture for you right now. The only way a market is going to sustain a move and never come back is it needs to turn from the 1 minute on the chart, the 5 minute, the 15 minute, the 30 minute, the hour, the 4-hour, the daily, the weekly, the monthly, and so on above that to never come back. All traders need to simultaneously agree. And the most important ones are the higher ones. The higher the time frame that whatever their stable view of the market is and where they are in their round trip process is how far the market's going to turn to. That's why you'll see what looks like an aggressive pullback on a 5 or a 15-minute chart, but it doesn't look like really much of anything on the 4-hour or the daily. Those guys, everything's good for them. They haven't seen anything that would discourage them at the moment. So all pullbacks that you deal with are only going to be relative to the highest time frame that is still in the midst of their round trip. Everyone with me on this? I know this is a little detailed here. Okay, cool. So let's look at a more in-depth illustration of the retail trader's round trip cycle. So again, a round trip trade is complete trade idea execution from initiation to closing. A retail trader's round trip trade is mainly initiated because of two things: technical price patterns and news. We're talking about retail trader mindset. And also, again, when I talk about retail traders, we're talking more about just a mindset and understanding of how the markets work, more of from a naive perspective. this also can bleed into what some people would consider smart money. Hedge funds, people like that, they make dumb decisions too. So they're not all smart, even though they have a lot of money to manage. So understand there's a range of this, but we just say retail trader as a blanket statement of someone who's either acting dumb or is naive about how this works. Okay, so looking at the round trip cycle on the left, we have kind of this circular graphic here that's going to walk us through the steps, and on the right, that's going to correlate with the actual chart pattern. So a new belief pattern is triggered. Everything starts from a new reason to buy or sell, right? In this case, looking at the words here, the market looks like it's bouncing long. I think I'm going to buy, some trader once said, right? So that's enough to trigger a new belief pattern in them. Cool. So they buy. That goes to them actually buying. Reason I made this graphic go up like it is because I know that most traders are not going to buy at the support level. The better ones will, but a lot of them will see it bounce on support, be like, that looks like it's bouncing. And then about this moment is where they feel like, oh, I should have got the bounce, but it's going now. So I'm just going to get in. You guys know what I'm talking about here. So that's the reality of it, is that a lot of them are going to miss the tight trade placement with the risk management, and they're going to go off the confirmation. So they get in, they buy, and the market actually takes off. Great. And they think this one's going to the moon, right? We got the moon boys come in, right? So here it comes, it's all going up. Everything feels good, all looking good. But what do we know? Tying in with our other lessons, the most important lesson I think that I personally teach, pain and pleasure. This feels great. Who doesn't want to ride the rocket ship, right? But what we know is that the market does this all the time, over and over again, doesn't care what you want, doesn't care what I want, only cares about liquidity, and the liquidity was to the downside at this point. So as the market falls back, retail traders are in this illustration pushed out of the money. What we know about them is that they don't like to feel pain, and what was once a wonderful, joyous ride has now smacked them in the face with reality, and they are now at a loss, causing them to likely close a trade. So trader says, never mind, I'm out. We have a round trip trade that was completed here from a retail perspective. Buy from initial belief, breakout, bounce off support, to now I'm discouraged, I'm in pain, don't like this, and I'm out. Buying, selling. Liquidity happened, offered at two different prices because of this. Now let's look at the market maker's round trip cycle. Same setup here. Okay, new belief pattern triggered too from the market maker's perspective. Now their algorithms are all coded based on the beliefs of how they want to code their algorithms. Their proprietary trading is all based on beliefs. Somebody needs to believe that they are going to make money, either in the programming of their bot or in the execution of their actual trade. Okay, that's universal. The difference is the market maker is looking at the market from the business perspective. How am I going to buy something cheap and sell it at a higher price and make a profit? So how is that going to work out? That's the first question that needs to be answered no matter what. That's the only question that needs to be answered for them. Chart patterns are secondary. Okay? So in this situation, they're saying the buy liquidity from these stop losses is drying up, time to cut supply, now we go up. Some market maker once said. They're looking at the high up above here. They're saying I could dump my buy positions above this high. There are plenty of stop losses up there to harvest. So what do we see here? We see not only a reason to get in, but the reason they believe they are going to make money is because they have the ability to accumulate buy inventory from stop losses, because those stop losses are all sell orders from previous buyers. That's why they're under the lows. So the opposite of that is a buy position, not to get too complicated here. So they have been able to accumulate at a discount from lesser informed traders. Okay, that's half the business. Now they're thinking, if they're good, how am I going to sell this? How do I offload this stuff for a profit? That's thought out in advance. So market drives up and they head to that high. They cut supply. They let organic buying demand come back into the market. Let it push price up because they're on for the ride now. It's profit. No reason to manipulate through this area on this time frame. You know, stuff happens across different time frames. They're trying to milk every time frame for profit. So they could be proprietary trading a big position, and you'll still get master patterns on the tick in the 1 minute from the algorithm that is still trying to milk even more money out of it. It's all doing the same thing across different time frames. Important to understand that here. That's very difficult sometimes to get your head around. But even though they're proprietary trading, they know that they're still making money on the fast time frame through spread and that faster manipulation, catching those little pieces. So what it looks like from a broad perspective is that they're in all trades in every direction all the time from the high end, which can look like nothing. But in reality, they're working every little potential possibility, either through an automated algorithm or the bigger, longer term stuff through proprietary trading, just because of the nature of how it works. So keep that in mind. So they drive it up, it goes through. Okay, they're able to offload some inventory here. But what do they say? They say, all right, we're here. But retail is starting to go short. Uh-oh, a little change in plan here. So what's happening? What they thought was going to happen was going to be tons of buying. No, retail trader has switched, or the retail mindset. They want to go short. So we got a little bit of a situation to deal with here from the market maker's perspective. Retail traders started to go short. I need more liquidity to get out. I haven't been able to offload my positions, right? Plus, market makers starting to feel like, I think that we need to go short here as well. This might be, market is ranging out. There's indecision on the higher time frames. Okay, time to range out. We need to go short here as well. Cool. So how do they deal with this? They bid the market up real quick. They have a bracket in which they can manipulate the market. They can't do it eternally, but they can do it within a range. I don't know the exact range, so I don't have an exact pip size to tell you. But depending on their resources and depending on the situation, they have some control to do this. Okay? That can be a completely artificial, manipulated price spike based off of them bidding up the price quickly. Totally artificially. What that does, all in one fell swoop, was anyone that was starting to short gets stopped out. Retail traders that don't know what they're looking at think like, I was wrong. This thing is going to the moon again. They get in long. So now we have short stops getting activated, which are buy orders. Plus we have new buying activity flooding in based off of the temptation of what this looks like. What does that create for the market maker? It creates a huge opportunity to sell because you got a bunch of buy liquidity coming in, right? So they sell to that and they harvest the stop losses plus the new buyers. They take it all in-house because they have the power to do so. Remember, they control the supply. They could take as much demand in-house. They have no obligation to match you organically. It's all theirs at this price. Why? Because it's favorable to them. As it goes down, they sell the market, and that is their round trip. So I kind of took this a step further just because I'm passionate about explaining this concept, but we are talking about round trip. So I'm talking about it one step past how they're going to make money on the downside. But for the simplicity, going back to the lesson here, you see where the buy is, you see where the sell is at the top. That's their round trip trade as opposed to the retail trader. The difference here that I want you to get is the thought process. I think that's the important lesson here. The other one is just looking at the chart patterns, kind of naively going about it. The other one is looking at liquidity, and you can see that who has the more profitable round trip thought process or way to approach the market is obviously the market maker. So that's what you guys want to take away from this. So that's their round trip cycle. That is what would cause a market maker or the banks that really stabilize and drive price. This is what causes them to complete their round trip, because their round trip trades stabilize market directions as well, which we're going to connect all this here in a second. Okay, so test time. It's the first test of this course. I think the only one. When does the move start? Okay, we have a 4-hour bar chart here going down. I think it was the same one we had before. Okay, did the move start right here? Or did the move start right here? Well, we know what it is. So, because I put there. The move started there. Why? Why did the move ultimately start there? Because that's where the higher time frame round trip completed. We're looking at a weekly bar chart here. You see that the weekly drove up through that previous high. We have the little red line there. All the weekly traders, when you get through a big predominant high, and this is on every time frame, but we're talking about the weekly in this situation. When you get through a big predominant high, what would you be thinking? I wonder if this is going to keep going up, right? We're all thinking the same thing. But now, like anytime you bust through a high or a low, it's like you're kind of like left out there to hang. Like, I wonder if the people are going to keep coming in behind me. When they don't, what do? You get real finicky. You're like, maybe it's not going. So in this situation where we come through this predominant high, all the weekly traders all have the same thought that are in profit. I wonder if this is going to end. It's not going to take much to get them to be like, okay, I'm done. When that happens, what do you have happen? You have a bunch of people that trade on a weekly time frame basis make a decision. What is that decision? The decision is to sell. What does that do? It dumps supply into the market. What do all those people also look at? They're probably opening up new positions to go short. In general, right? So we're talking about stable time flow of money. Those people are going to be now looking at this weekly chart as they close their buy positions at the top of this, open new sell positions at the turn. When are they going to make their next decision as they enter sell positions? Probably in a similar fashion to the last decision, coming through a predominant high or low, in this case low. That's going to be their next decision point. And they're all going to be watching carefully as they go through those lows. Now we look at the 4-hour bar chart, going back on the side there. The reason why those rallies are failing is because in this case especially, we have the weekly chart supporting that. Why is it supporting that? Because those round trip traders are in the midst of a new selling belief. They have not seen anything on the chart that would cause them to buy back and put demand back in the market, boosting the price up. Therefore, the 4-hour is not strong enough to overcome and disrupt their round trip. Everyone with me on this one? This makes sense? I know it's complicated. And that is why multi-time frame analysis, which is level 2 understanding of this, why it's so important, why I think it's better. I do think that a moving average can achieve this understanding to some degree, because a moving average does represent an average of a much higher time frame. The problem is the settings and all those things. Why I've always favored personally looking at a higher time frame is because I can see the pattern. I can see the highs and lows. I can see the detailed reaction. But in reality, you can tune a moving average to represent this type of thing. And that's essentially what it's showing you. So it can happen. And that's why I did that lesson on YouTube a while back, talking about how to use moving averages the right way. I forget what the lesson's called. But I kind of went through a thought process of how to do that, and how to change the setting according to having it mirror the time frame and having some methodical process to doing that. So that is there, and this is what I had in mind when I did that lesson. But This is really it. Because at the end of the day, what we're trying to answer through this lesson is trusting trends. That's the big question here. If we can trust the trend, then our overvalued or undervalued entries feel a lot safer. We're willing to put more positions in. We're willing to go a little heavier on those positions. We're willing to give it a little more room. And so by understanding why market reversals are actually going to happen or continue has everything to do with this. It has everything to do with those higher timeframes completing their round trip. I've heard a lot of people, one of a common question that I've answered a number of times is they're like, but doesn't it start like on the 1 minute chart? Wouldn't that be the chart that starts the reversal? That's the first chart that you see, correct. But the 1 minute pullback is only as strong as the next time frame willing to complete their round trip. So while a 1 minute can absolutely start, the 1 minute that is the top, the tippity top or the tippity bottom is simultaneously combined. That 1 minute is reflected in the weekly, monthly, daily, whatever the higher time frame decision, all happening at the same time. The 1 minute alone is meaningless. It has to be the 1 minute trader is making the same decision as the daily, weekly, monthly trader. If we're talking about those higher time frames, that's where you get the massive, massive rotation. Without their backing, it will not be sustained. So just want to be clear on that. And hopefully I'm hoping this slide kind of like really cements in the thought process behind this. So in review on this one, this isn't the end of the lesson, but a quick review. The completed round trip process on higher time frames is what causes trend reversals. Okay. When the higher time frame players complete their round trip process, their closing volume combined with shorter term traders' volume is what causes the bigger price reversal. So their completion of round trip plus the added of what because by this, the short term traders are also going to see the trend changing. They have every reason to trade different ups and downs, but now they're seeing that it's getting backed. They're even going to go heavier. But it's only at the authority of the higher time frame, and their closing volume is what starts the real market reversal. If they join the reversal, then that's what will stabilize it going further. Okay, all pullbacks in the market will be temporary until the higher time frame players complete their round trip process. The pullback is only as strong as to the higher time frame player that still is in the midst of their round trip, meaning they don't have a good enough reason en masse to close out their trades. You would need really, if we're looking at, let's say, daily traders looking at the daily chart, you would need over 50% of the people stabilizing that daily chart to change their mind. With a moment, 50% of those time frame specific traders complete their round trip or start a new round trip in the other direction. That's when you actually get a full-blown reversal. It's got to tilt the scale. Okay, so your ability to forecast the market accurately is highly dependent on understanding the higher time frame mindset and technicals. If you spend time studying the higher time frame round trip process, you will gain much more insight and confidence in your shorter term opportunities. That's key here. So how do we know when a round trip may be nearing completion? Just to reiterate here, we have a reaction above a high looking at the weekly bar chart here. So when you see your higher time frame, if you're trading, let's say a 30-minute into a daily, you not only want to be cautious when we come through liquidity line levels, if we're using the software, but pretty much every predominant high and low. Don't overthink it. Look slightly to the left of the chart. What's poking out like this or like this? Those levels, look at them. Everyone else is. So they're going to cause some sort of typical reaction. And you need to be cautious. Doesn't mean you need to stop trading, but you need to be cautious to navigate your lower time frame entries at those zones. Okay. 2, look for inefficiencies for confirmation. So we see that in this case, it poked through the high. What do we want to see for confirmation as it goes? We want to see that little gap action. We want to see the market push, leave that inefficiency. That shows that the banks are letting the thing slip. They're letting it go. And we know that as a confirmation of the trend or the trend change on ATS trend. We want to watch how the market trades into those inefficiencies, which is the new established trend. So that's kind of the 3-step criteria for understanding a higher time frame reversal. Watch the highs and lows. Watch for a turn on those first, a reaction. Watch for a resulting inefficiency, which kind of confirms, yeah, they definitely changed their mind, and then trade in that. Everyone with me on that? Make sense? Cool. Is it always perfectly straightforward? No, not perfectly straightforward. But the cool thing that we could do as traders, that we all don't do, but we should, the cool thing that we could do that is a massive power that you have that most people disregard is your ability to pick and choose what you interact with. It's like if you want to put together a puzzle, do you want to put together like a 5,000 piece puzzle with those tiny, tiny pieces? It's really complicated. Or do you want to wait till someone brings out a puzzle that's like the ones that we played with when we were like 5 years old with these giant pieces? And you can like just put them together and it's like 15 pieces and it's done. Okay? That is the power that we have as traders to only interact with the kindergarten puzzle. What does that equate to in the market? It equates to patterns that you can clearly see and understand. You might still get the piece wrong, but there is nobody here forcing you to put together a 5,000 piece puzzle. The problem that you have to deal with is feeling like you're not making progress. This plays into all the other things that we talk about. To feeling like I'm never going to get a kindergarten puzzle, or all the puzzles are hard. That's the belief. A lot of them are. They're more intermediate, But we're talking about this analogy, going a little deep here. But that's the reality of it, is that part of your effectiveness at being a really disciplined trader and being a really effective trader is not interacting with anything that is not as clear as possible. And you having enough emotional intelligence to understand what it is, what the level is that you're at of understanding to clearly see what the potentials are in the market. That really is, at the end of the day, part of the massive edge that you can have in yourself that no one else can really do for you. That is having the emotional intelligence to sit out of the market potentially for a month at a time because your market is just terrible. The puzzle is too complicated. It really doesn't matter. The emotionally intelligent trader, the one that's been around the block, is going to know, ideally from experience, that if their market is less than ideal or choppy, the outcome that they will get, let's say over the next 30 days of trading that less than ideal market, the complicated puzzle, could be net negative, frustration, and overall going backwards. The emotionally intelligent good trader would understand what they're looking at and would be net positive even if they didn't trade because they protected their capital. They're not scared to trade. They don't not know how to trade. They simply are picking the puzzles that they are good at putting together. So they are not having to work back their account because the markets were not trending and weren't clear in these components we're talking about. They don't have to make up for lost time. This is where, if you're really good at this, which again, everybody goes through difficult times. I'm just telling you guys where the bar is here. This is the bar of exceptional mastery. This is where you are so good, it's insane. And we all will struggle to meet this. But I'm telling you, this is what I know about it. And being there at different times in my own experience, sometimes not so great, but I do know that if you trust that the market is going to land and hand you puzzles on a generally regular basis that are easier to put together, and you wait for that, the feeling of the level of the puzzle that you know you're really good at, and you only interact with that puzzle, you are going to be insanely more profitable and less stressed out and just more effective in every which way than everyone else that doesn't believe they're going to get a less complicated puzzle. And it's really just comes down to faith in that situation is going to come and being disciplined to wait for it. And understanding that your activity, just simply being in trades and trading whatever the market has all the time, is going to be it's going to be less effective for you overall. And if anything, it's going to steal a lot of your energy. And at the worst case scenario, you're going to lose money that you're going to have to make up. And you know how you're going to make up for it? With easy puzzles. So the goal in reality should be to identify ideal conditions, understanding the higher time frame, where it is in the round trip cycle, understanding all that stuff. That really is the job of the trader, is more about scoping out condition rather than anybody can push the button. Anyone can be in a trade. The professional is, what trade do I need to be in? And understanding when to step back, not that you're timid, not that you're losing your edge, that you can't handle it. It's understanding I'm stepping back because I know the puzzles that I look for. I've studied market conditions. I've lived through market conditions, and I understand where I operate the best for my level. And you become an expert at identifying those conditions early and then not hesitating when they are there. For better, for worse, and when you navigate it wrong, have faith in your approach and in the long term of that. That's that if you keep doing that, it'll work out okay. So that's just been my experience. I do personally my best when I focus on that. When I get led into situations, which I have a number of times, that were less than ideal for a number of different reasons, you always find, what I've always found is like I created potentially either a break-even situation or an unnecessary hole that I need to now dig myself out of with ideal condition. It's like, why didn't I just focus on ideal condition in the first place? That is the entire point of the ATS Assistant. It's still an imperfect tool, but it's a condition identifying tool. That's all it is. And so that's what we're trying to utilize those for, is to really, really dial in on and program that to situations that we are ultra effective at. So, okay, I think I beat that horse. It is dead now. So let's go to the next one. So remember, if a daily bar chart in this example is headed down, we can see it created by the inefficiency. It's moving down. Or if we have a 1 hour bar chart, you can do 1 hour, 30 minute, both work inside the daily. 30 minutes a little better in my opinion. Everything that's overvalued, why are these rallies above value going to fail? Why are they going to fail? Is because they are only going to be as strong enough as the higher time frame allows. In this case, that daily on the left, confirmed by the inefficiency, ATS trend following it, those daily traders have not seen enough to fully dump. Yes, we're getting pullbacks, but is that over 50% of the daily traders? It can't be. It's enough to bid up the price, but it is not enough to change that direction. So your job, again, get inside the head of your directional bias time frame. What are they thinking? If you feel like you are in a period where they're relatively stable, it's time to go for it on your lower time frame. And you got the framework to do it. Whether you're using ATS software, if you're watching these tutorials or watching these classes, you can map this out. I show you how to do that on my videos. Don't need the software to do this. If you map out fair market value, you'll know that anytime you get above that, it's only going to go as far as the higher time frame allows it. So that's really the big key here, is understanding that if you're using ATS software, you have the framework there more than enough. It does not need to be more complicated than this. So, okay, so what's the takeaway? This is the actual end. Trends will not end on any given time frame until the even higher time frames complete their round trip process in mass, over 50%. If you're tired of getting caught in trend reversals, the clarity and confidence that you seek is in understanding the higher time frames mindset, positioning, and round trip transaction speed. We need their stability to give us the confidence to do what feels very crazy on the lower time frame. We're trying to sell the highs and buy the lows according to value when other traders are breakout trading the opposite. The only way we have confidence to do that is by doing our homework on the higher time frame, waiting for the quality condition. Okay? When you put all of this into practice, you will become the confident trend trader that you want to be. And this, what you guys learned in this is in my belief, my experience after working with a lot of people, getting feedback on this other than my own, this understanding is the best that I've been able to put together that will show you how to navigate the trends and operate in a quality way. So that's the end of this lesson. Do you guys have any questions on this particular material?
Okay. Hi, Wade. Thanks for the lesson. Are there round trips on the lower time frame embedded within the higher time frame round trips? Like, can there be multiple round trips on the lower time frame within the higher?
Yep. There's always a round trip trade going on, and it's all just dependent on the chart patterns of that time frame. So again, it is just a matter of what patterns have been formed and the belief to get in and the belief to get out. A trader looking at a 1 minute time frame is going to get a lot of ups and downs to look at. So they are going to be highly influenced by support and resistance areas, really is the biggest one, on the 1 minute time frame. So when you get to a high, it's the same thing, just like we looked at on the weekly chart. When that weekly came through and poked through that high on our illustration, when we talk about what are all the weekly players thinking, they're all thinking, is it going to go higher, right? And if they get any kind of price action, that first like 20%, 30%, 40% of weekly traders start dumping, then the rest kind of domino in, right? So a 1 minute trader, what are they looking at? They're looking at the same situation. It pokes through a high, 1 minute goes by, 2 minutes go by. The minute 50% of those traders looking at that particular pattern in that particular situation start to dump, the 1 minute trades back down into the range or reverses. And so it's all relevant to the patterns that they're trading. A 1 minute trend is only stabilized by the next guy that's willing to buy into that bias on the 1 minute. But when they en masse on that time frame change their mind, that time frame changes as well. It has to. And that's why we need the stability. We want to be in the midst of the round trip on the higher time frames, because then we're taking advantage of all the people trading against that higher time frame flow of money, that higher time frame round trip that's intact still. And then we know that we can do a quick trade in the way a trade is supposed to be done, which is liquidity to get in, liquidity to get out. That's where we look at fair market value. So if our higher time frame trade is up, round trip is still intact as far as we can tell, it's going up, and we see something undervalued on the lower time frame, those people on that time frame are selling. They are making the wrong decision. And we need someone to make the wrong decision in order to make the right decision. And so we are coordinating our trading efforts with the best practices of how the market works, all put together. And through these lessons, through this one, through all of them, you guys that are watching this, that are learning this for the first time, and everyone in here that already knows this stuff, appreciate you guys going through this. You guys, when you put this all together, that's why we call it the 4 pillars of trading mastery in these lessons. This is the stuff that I feel like if I had to teach someone only what they needed to know, I couldn't leave one of these things out. Is there more than this? Yeah, absolutely. There's a bunch of rabbit holes to go down. But I feel like if someone is learning to trade, this is, as a whole, you can't leave anything out that I'm talking about here to have a complete understanding of what you're actually dealing with. So I know that goes above and beyond your question, but did that cover your question, Bowden? At least
Yes, it
some of it?
does.
Perfect. Thank you. So, and Bowden is a lot smarter. He knows a lot more of this stuff, but he's also helping me bring some questions out that those of you guys that are new may be thinking. So, and so you guys know, I think I said this on lessons, the group that I'm here with right now is the more inner circle of Trade ATS. These are people that are very smart and doing quite well in their journey. So it's a great group, and I'm honored to be here doing this with you guys. So Joel, let me unmute you real quick here.
Hello, Will. Can you guys hear me?
I could hear you. Go for it, Joel.
Okay. Fun questions. So, for example, if you're trading the 5 minute into the 4 hour, and then let's say the directional buy is 4 hour and it's short, and then you see an opportunity on the 5 minute that is above value, you take it. But the daily is long, and you see an opportunity in the 5 minute that goes long, and you take it. Is that okay? So it's kind of having two directional buyers in the same entry. It's like you're being smart, but I've done it, but I'm just asking if it's okay.
I got it. So you're talking about the very confusing situation of having you're trading a 5 minute chart, your 4 hour directional bias is short. Meanwhile, your daily is long, and those are closely related.
Yes.
So,
and then you find an opportunity to go short, that is using the 4 hour as a bias, and you take it. It works, and then you see another opportunity to go long because the daily is long. On your 5 minute, you take it, and it works. But
I'd say you're double dipping over there.
Yes.
Okay. So my thoughts on that, it really comes down to what you're talking about is valid, because a 4 hour and a daily are very closely related, and they can have a really good correlation to show you momentum. Ideally, you like to have the 4 hour in direction with the daily, because we're trying to judge those candle by candle. So that is great to have those in alignment. However, when they are misaligned, meaning you have a situation like that on your 4 hour short, dailies long, what that typically signals is that you're in a big whippy range, and it's usually going to be, you're going to have messy price action for the most part on the lower time frames than the 4 hour, 15 minute, 5 minute, to be exact. So that's going to be, it's going to get kind of sketchy in that situation. You need to be careful with that. Also, the daily is a higher time frame. So in reality, the better opportunity is probably staying in line with the daily. The question is, you're now trading kind of the rotation of the 4 hour back in line with the daily. Now, if someone really knows ATS and has a lot of experience in this situation, if you've seen it go by a lot, you can trade that.
That's right. That's right.
You can trade that.
Especially using the master pattern origination point in your 5 minutes, because the swings are long. You can do it.
Yeah, absolutely. But everything that I say, that I'm always going to push people towards the most conservative way to do it, because ultimately what's not great about the situation you're talking about, and we just spent a bunch of time talking about, is quality market condition. And if you have a 4 hour that is misaligned with a daily, would I say that is, if you're trading a 5 minute as your entry, the way those timeframes correlate together, would you say, Joel, that is a perfect market condition? Even though you understand it, is that a great market condition for probability?
It's not. In fact, don't try this at home. It's difficult.
Yeah, exactly. So that's my stance on that. And that's a great question, because that happens all the time. We get so many inquiries into support with that exact question. It's like, what do I do in this? And all I could tell you, the technicals are not difficult. What's difficult is waiting for the quality market condition, because very much what Joel's talking about, for anyone listening to this lesson, what you're like, hey, I can make money in the short direction of the 5 minute into the 4 hour, and you did, but now I'm at the bottom, I'm undervalued, and the daily's still long. Now I can reverse that and go long. I will tell you that that's trading both ways, and overall, I would say if you do that over the course of 100 opportunities that have that criteria, that I don't believe you will be that much further ahead, even if you're really good, than just letting that go by and letting things align. And that varies. All the situations are slightly different, but that's my stance on it, is I don't think, especially the average trader, is going to be any further ahead, even if you take it both ways. I think that there will be the next few opportunities you're going to get slapped, and the daily will kick in, or the 4 hour could kick in, especially because those are closely related, and you're going to get mowed down. So ideally, we want to wait for that alignment, wait for that grade A trade placement, ideally, and then engage. So
you're right, Wade. You're right.
So cool. Thanks for that was a great question, Joel. Does anyone else have any other questions? All right. I think we're good. So, all right. Well, thanks again for going through this lesson with me, guys. Appreciate it. And we'll cut it right there.